Well, good morning. Thank you for inviting Neel to this opportunity to quiz him and listen to some of his experiences. So Neel and I have done this before, so what my role here today, and I'll kind of tell you how the program is that we'll open it up. I've got a couple of questions just to kind of start the conversation. And then after that, we encourage people to go to a mic and ask questions. We're going to try to stay with the program, the agenda, and get us out of here about between 8:20 and 8:25. But on behalf of Neel and myself, thanks for the opportunity to speak today. So Neel?
Well, thanks, Harry, and again, thanks for inviting me, and thanks for joining me. You know, a big part of my job, I've been at the Minneapolis Fed since January. I'm president of the Minneapolis Fed. Part of my job is to get out across the 9th Federal Reserve District, hear from people directly what's happening in the district, to inform us about what's happening on the ground in the local economy. Now, a lot of folks don't know this, but if you go back in history, 100 years ago, when Congress created the Federal Reserve System, they did something unusual. Like most countries that they have a central bank, the central bank is headquartered in the nation's capital, and it's entirely in the nation's capital. Well, 100 years ago, Congress said, we need a central bank, but we don't want all the power concentrated in Washington, D.C. or in New York. And that's why they created these, these regional Federal Reserve banks. So the 9th Federal Reserve Bank is the Minneapolis Fed. Our job is to represent the 9th Federal Reserve District, which is Minnesota, North and South Dakota, Montana, a little part of Michigan, a little part of Wisconsin, and be able to bring the local experience back to Washington, D.C. So I go back to Washington, D.C. 8 times a year. I was there last week for the Federal Open Market Committee meetings. And my contribution there is not only looking at what's happening in the U.S. economy across the whole country, but specifically what's happening in the 9th District. So thank you for inviting me today. I'm eager to hear from you what you're seeing and answer your questions as well. So a little bit of an overview.
Great. So most of you read in the paper that Neel has this came in with very quietly and has this concept about banks being too big to fail. So maybe you might want to share with the group your thoughts on that and where we're headed.
Sure. So I was at Treasury as you all heard, from 06 to 09, and I led the TARP program, which was very controversial at the time, and it's still very controversial. It was the right thing to do because we're in the middle of a crisis and we wanted to avoid a Great Depression scenario. But the question is, could this happen again? Are the big banks still too big to fail? Could the taxpayers be on the hook in the future? And unfortunately, a lot of regulatory reforms have happened, but unfortunately, in my judgment, the biggest banks are still too big to fail, and that if they were to run into trouble again today, we would have no choice but to turn back to the taxpayers and say, hey, we need to bail them out. Not for their own sake, but for everybody else's sake. And I'll give you an analogy. An analogy is that of a nuclear reactor. Each of you understands intuitively that if a nuclear reactor melted down, it would be devastating for the community that it sits in. So what would happen? The government, as we saw in Japan, would do everything they could to try to prevent that reactor from melting down, regardless of the cost. Well, that doesn't mean we ban all nuclear power plants, but that means we regulate the heck out of them to make the odds of that happening extremely low. So in February, we announced an initiative at the Minneapolis Fed to try to end the problem of too big to fail banks. So we've been having a series of public symposiums at our bank, and Harry's been there among others. We've brought the best experts in the world to Minneapolis to hear from them a wide range of options of how you could actually address this problem. Everything from breaking up the banks to regulating them like nuclear reactors and other options to say, could we really address this? And we've made a lot of progress in educating ourselves and educating the public about this. And we are on track toward the end of the year to release the Minneapolis Fed's plan of how to actually address too big to fail once and for all. This is all about trade-offs. Every one of you, I guarantee every one of you understands that we cannot take the risk of terrorism down to zero. You know intuitively there's always going to be some risk, and to reduce risk comes with some costs. Paying for more law enforcement, paying for more intelligence, paying for personal safety. Maybe you go through metal detectors. There are costs that we pay. So there's a trade-off between safety and costs. Same thing in the financial system. So what we're going to present to you, the public, is here's our assessment of how much risk still remains today in the financial system. Here are some options. Here are the costs associated with them. And ultimately, the American people need to decide how much safety you want and what cost you're willing to pay for it.
Any comments or questions on that topic to Neel? Go ahead, sir. There's microphones, but if
Or you can
if
speak up, we'll
yeah.
repeat your question.
Thank you. So this is tangentially related to what we're talking about. Obviously, Fed policy is the news, and you watch CNBC. The emphasis is that the Fed really needs to raise rates. For some reason, that's the narrative, and the Fed is somehow chickening out from raising rates. That's one narrative out there, at least. In terms of the risks of not raising rates, could you compare the current period to the last period of low rates following the tech crash? We have low rates for a long time, and people then assume that those low rates created the quote-unquote housing bubble that created the problem with banks being too big to fail. From your observation now, do you see anything to suggest that we're seeing those kind of excesses now, and that the Fed needs to be preemptive about that? Because, and I'd like your view on this, is the real economy too high, and do we need to raise rates?
Okay, so this is a monetary policy question where the gentleman said that some folks, especially if you turn on TV, business television, will say, hey, the Fed is behind the curve, the Fed needs to raise rates, could excesses be building in the economy, maybe low rates caused the housing bubble, then we had the terrible crash, could that be happening again, what are the risks associated with that? So I do look at this from a risk management perspective, and if you look all around the world, so the U.S. economy for the last 4 years has been having inflation that's below target. If you just we look at core inflation, it's called core PCE, because headline rates move around a lot because of energy and fuel prices. Core is steadier. So we look at core inflation and headline inflation, but they're both coming up short here in the U.S. Core inflation right now is around 1.6% when our target is 2%. Now this is not just a U.S. phenomenon. Europe, inflation is coming up low. Japan, inflation is coming up low. So some of these phenomena are global rather than just local or domestic phenomenon. So in the U.S., our inflation is coming up low consistently for 4 years. Inflation expectations, which is very, very important to our economy and the future of our economy, they are either solidly anchored or they're drifting down. And we measure inflation expectations by looking at surveys of investors and consumers as well as financial market data. They're all pointing in the same direction, solid or down. And the job market keeps creating jobs at a pretty healthy clip, right? Most recently, around 150,000 jobs a month. The U.S. economy needs somewhere between 80 and 100, 120,000 jobs a month to keep up with population growth. So the economy is creating jobs faster than our population is growing, and yet the headline unemployment rate has not come down. It's still at 4.9%. So this is a very interesting thing. Workers are coming off the sidelines, re-entering the labor force, and as yet that is not inflationary. So the reason I'm telling you all this is because all of that suggests the economy still has room to run before it overheats. And the risk management perspective, if inflation starts creeping up, we have complete tools to lock it down. And that means we raise rates. If inflation stays low, we have far fewer tools because of the zero lower bound. We can only lower rates so far. We've only raised rates once so far. And so purely from a risk management perspective, the risk of low inflation is much more problematic than the risk of high inflation because we have the tools to deal with it. And we are monitoring asset markets around the country and around the world. We don't yet see, now sometimes these things are hard to know until they happen and then it could be too late. We don't see that there's a housing bubble reforming. We do have some concerns around commercial real estate, and our bank regulators are looking at the banks that we regulate to try to make sure that they're not taking on too much risk. But monetary policy is an incredibly blunt tool. And if we went back into the early 2000s and said, well, housing is overheating or housing is starting to get hot, if the Fed had raised rates aggressively in 2003, 2004, that could be a very, very painful way of trying to depress what may or may not be a bubble. And so we try to look at other tools to keep those excesses in check. Sorry, long answer to your question, but it was an important, complicated question.
Go ahead, sir.
Let me ask somebody, could somebody bring a mic up here? And then we'll just hand you the mic. because otherwise I'll spend half the time repeating your question.
Thanks.
Thank you.
So for what if, let's say the opposite happens, and I hear a lot of talk about rates could go negative. In your mind, what is the probability that that could happen? And if it did happen, what impact would it have on us economically?
Well, I think some countries are experimenting with low rates because, again, we're seeing this global phenomenon of, if you go back up, for 30 years, interest rates all around the world have been declining since around 1980 or so. And the honest answer is we're not exactly sure why that's been happening. It's likely a combination of demographic trends around the world, savings around the world, investment around the world, technology development, all of this combining, driving real interest rates around the world down. And so many countries are now bumping into the zero lower bound, and some economies have said, we're going to take our rates negative to try to stimulate savings and try to stimulate more investment. Now, it isn't clear that negative rates are having the desired effect. So you would think if rates are negative, that's a real penalty to saving. So you're like, I'm not going to save money if I'm going to get a negative return. I'm going to go spend the money. I'm going to go invest. But it could be happening that it's scaring people. People are saying, wow, things are so bad that rates are now negative. I'm going to save more. And so it may actually be happening, having the opposite effect of what policymakers intended. So my view is, in the U.S., it's very unlikely that the Federal Reserve would adopt a policy of negative interest rates. Though, never say never, it's not impossible. We think that there are other tools that we would go to, such as other types of quantitative easing, other types of forward guidance, to try to ease monetary conditions before we would go to the step of negative interest rates, because negative interest rates may have different effects in the U.S. economy that they're having in some other economies around the world.
We're going to take it back a little bit. Most of you are aware that Neel was right in the middle of things during 2008. AIG, Lehman Brothers, Stearns, people were hemorrhaging. Maybe you can share a little bit with the crowd what it was like to be kind of at the epicenter of this financial crisis that we all experienced.
Sure. Honestly, it was terrifying. I mean, in the worst moments, we thought there was a very real risk that could be the next day or the next week, the whole financial system would collapse. And the thing that terrified us even more than how to prevent the collapse is, what do we do if thousands of banks in America fail simultaneously? How do we restart the U.S. economy? I have a mortgage now. I had a mortgage at the time, and I kept thinking to myself, my savings was in a money market account. There were a few moments when I thought to myself, I'm going to lose my house because my savings is in my money market account, and I'm paying the mortgage, my salary. I bought my house when I was working in the private sector. I gave up my private sector job to take a job in government. My salary went down pretty substantially, and now I have this mortgage to pay. And so I'm thinking to myself, my God, I'm going to lose my house. I better transfer my money from my money market account to my checking account, because my checking account is more likely to survive than my money market account. I didn't do that because I realized it wouldn't have been ethical for me to do that, because I feel like I had an information advantage over the public of just how bad things were. And I finally concluded, well, if I lose my house, millions of Americans are losing their homes, so I'm going to have a lot of company. So it was absolutely terrifying. I mean, I remember one night, 10 o'clock at night, and by the way, I was sleeping in my office working 7 days a week. It wasn't just me. It was 12, 18 hours a day, some all-nighters, just trying to get through it. I remember one night, 10 o'clock at night, an economist came in my office. She was sobbing, and she said, the financial system is collapsing. What are we going to do? And I said, all we can do is get our programs up and running as quickly as we can and hope that it's enough. And if it's not enough, we will figure out how to put the pieces back together. And, the good news is we had a wonderful team of people, totally non-political, just people who, either government employees or people who volunteered from the private sector, people who said, we're going to do whatever it takes to try to get the U.S. economy through this. And politics had nothing to do with it. And so it was one of the worst moments economically in our nation's history, but it was one of the proudest moments. They would never feel this way at the time, but one of the proudest moments politically, because you saw Republicans and Democrats come together, put their political careers on the line to make really controversial votes, to do the right thing for the country, and many of those folks who voted for the TARP paid with their political careers. But it was the right thing to do.
Questions on that item? Okay. Another thing that Neel's doing at the Fed too is he's looking at. Neel came to Minnesota with the idea that it was this group of Scandinavians that immigrated from across the sea and realized that we are a very, very diverse community and becoming much more so. Neel, can you kind of comment on that? I know that the bank is looking at that and seeing how that we can engage business and others to really deal with an employee crisis that we may have.
Sure. One of my surprises, when I started studying about Minnesota and the 9th District, this is a remarkable state, very diverse economy. Virtually every sector of the U.S. economy is represented here in some scale. And it's a strong economy, overall good education system, a lot to be proud of. My biggest surprise when coming here was to understand some of the gaps, though. So by and large, the median Minnesotan is doing very well, but you look at the gaps in certain sectors, certain pockets, the gaps are larger here than they are in many other places around the country. Racial disparity, education disparity, income disparity. And so I wanted to understand why that is. And so we're just beginning. I'm getting out across the community, trying to understand what are some of the structural factors, and we at the bank are trying to engage in these issues as well from an economic research perspective. I'll give you a factoid which opened my eyes, and this isn't unique to Minnesota. Black unemployment in America is always roughly 2 times white unemployment. So if it's a booming economy and white unemployment is 4%, pretty darn good chance black unemployment in America is going to be 8%. If it's a recession and white unemployment is 7%, black unemployment is pretty darn close going to be 14%. And I've been asking economists, experts, why is that? What is the structural factor that creates that gap? The answer is, much to my surprise, we don't really know. What are the structural factors? Part of it's education, but even if you adjust for education, even within the same education group, let's say college graduate to college graduate, there are still these structural gaps. Why? And so, now I know monetary policy can't solve this. Monetary policy cannot be tailored to specific communities, to specific sectors. It's the bluntest instrument imaginable. But if we can use our economic research to understand what some of these structural factors are, and we can educate the public, then perhaps other policymakers can step in to try to close some of those gaps. Another thing, I talked about this. Coming out of the crisis, the economics profession expected that there was going to be a lost generation of workers as these long-term unemployed workers became permanently unemployable. And so economists said, well, we're back to full employment a couple years ago. All these other workers who were lost, they're gone. So don't consider them. Don't think about them in the economy. There's nothing you can do. Well, pleasantly, surprisingly, as the economy has continued to slowly recover and the job market has created jobs, folks have come back in. And they may have said, you know what, I've been out of the workforce for 3 or 4 or 5 years, but hey, I can get a job, I'm coming back in. So now we're seeing people re-enter the labor force. We're seeing labor force participation tick back up. That's a really good thing, not just for those workers, but for society as a whole. And so some of these very basic questions about the labor market, about what does maximum employment mean, we know less than we think we know. So let's be humble about it. Let's do the research. Let's keep our eyes open, and let's figure out what we can learn.
Great. Go ahead. Could you grab the mic, please? Thank you. And please, don't be afraid to ask Neel questions. He likes to mix it up.
Yeah,
you don't
tough,
have to act
tougher
like...
the better.
Okay.
Hi, yeah, thanks for taking the question. In terms of your last comment on the labor force, you've seen a big shift in the last 20 years from manufacturing to an IT economy. And how are you, or the Fed, looking at that? Do you have, what's your viewpoint of how that continues on? And it goes back to your earlier comments on education and the gaps in society. So any insights on that?
Well, it's enormously important, and this is one of those long-term secular and super secular trends that is here to stay. Trade is getting a people are really criticizing trade now a lot. A much bigger factor than trade is technology development. And self-driving cars are around the corner, and self-driving trucks are around the corner, which is going to be a net productivity enhancer for society. But man, that's going to be a powerful disruption on some pretty good jobs for a lot of people. And we as a society haven't begun to think through what that's going to mean. Now, I'm not suggesting we should resist, but I'm suggesting that this is probably going to demand other policy responses to help those workers who are affected by it and try to give people the training that they need. So as technology has developed, as we become more of a knowledge economy, the premium to education is just going up and up and up, and there's no signs of that slowing down. And so, this is way outside of the scope of monetary policy, but education and making sure that every kid in Minnesota, every kid in the U.S. has a good chance to get a good education has got to be one of our highest priorities for the country. Again, outside the scope of monetary policy or the Federal Reserve. A couple weeks ago, I wrote a paper, an essay, that I published on our website looking at why has the economic recovery been so slow and what can we do about it. And investing in education and making sure that young people get good education is key to increasing productivity growth, key to making sure people are able to get good jobs and compete in the global economy. There are other factors. Demographics is a big one. If you look at what are the drivers of economic growth, education is a big one. So a more skilled workforce. Another big one is technology development. Another big one is just a growing population. If you have a growing population, you have more workers and you have more consumers to buy things. Well, our population is now growing more slowly than it has in prior decades. As we become wealthier, our fertility rates have gone down. By the way, that's happening all around the world. It's happening in Europe, it's happening in Japan. Monetary policy cannot solve a slowly growing population. So you have three choices. You, the people, have three choices. You can either accept slow growth, you can either adopt policies to get the fertility rate up, which means tax policies, family leave policies. By the way, that's pretty expensive, but that's an option. Or number three, you can open the doors to more immigration. That's math. I'm not offering you value judgments on those three. That's just math. But as a country, we have to decide. So Japan is facing the exact same thing, much more severely than we are. As yet, the country culturally is very resistant to immigration. So what are they going to do? Just accept slower growth? Now, these are tough problems, right? And so I think what we can do is lay out these facts, lay out the math, and then ultimately the public, the people, need to decide which ones they want to tackle.
Mike's got a question.
Would you care to comment about what's going on at Wells?
Not really. Would I care to comment what's going on at Wells Fargo? And I said, not really. All I know is what I read in the papers. And obviously, I'm as concerned as anybody about this. And, I think the relevant regulators. So I'll say this. The Federal Reserve regulates the holding companies of banks, if they have holding companies. The bank itself is regulated by the OCC, the Office of the Comptroller and the Currency, and the CFPB. I think the appropriate regulators appear to be very focused on this issue, and Congress is obviously very focused on this issue, and I think that this needs to be addressed. And we need to learn from this to make sure it's not happening in other institutions. And the thing that always scares me, I didn't know anything about this a month ago. What else don't I know about? What else is happening that none of us know about? And so that's what's, it's alarming that this could have been going on at this scale for 4 or 5 years and it wasn't on people's radar screens. And so.
Go ahead.
I want to ask a policy question tied back to fiscal stimulus versus monetary stimulus. And the Fed's done a great job, I think, of helping the economy over the last 8 years, kind of greasing the wheels. But are we getting to a point now where it feels like monetary policy is losing its impact, and yet we aren't seeing Congress really step up with fiscal stimulus. And it comes back to some of the points that you were just making about policies that help the economy. And I think we're getting to the point now where maybe the Fed's job of what they should be doing is allowing Congress to not do their job on the fiscal side. And I think there's a lot of infighting related to that. When does that tension come to a head from the Fed standpoint of we're no longer going to be doing all the hand-holding, it's time for the other side of our government to be helping the economy set policies that actually create growth? Because I think there's been a lot of infighting to assure that we don't have the kind of growth that we potentially could.
So I agree that there's a lot that fiscal authorities could be doing, whether it's education, reform, and investments. I'm a big fan, by the way, for example, of government-funded basic research. I'm not talking commercialization. I'm not talking Solyndra. I'm talking about funding the National Science Foundation, funding NASA, funding DARPA, planting the seeds for future technological revolutions. I think there's a place for government support for things like that. So I think there's a lot. There's tax reform, there's regulatory reform. There are a lot of things that the fiscal side of the house could be doing to improve our competitiveness and our growth rate. And I talk about some of those things in this essay that I mentioned, which is on our website. So yes, absolutely. I don't believe, though, it would be appropriate for the Federal Reserve to say, you know what, we're not going to do our part to try to force their hand. I think our role is we have to take congressional action as an independent variable. They're going to act or they're not going to act. We have to look at the data. Congress created the Federal Reserve. Congress gave us what's called a dual mandate: stable prices and maximum employment. So we have to look around at the economic variables, one of which is congressional action, and say, let's just read what the data is providing us, and we will do our part based on that data. But I'm with you spiritually that the other policymakers need to step in and do their part. It can't just come down to the Fed. Again, the Fed monetary policy cannot solve a demographics problem. Monetary policy cannot solve a technology innovation problem. That's up to other parts of government to act.
So we're got time for a couple more questions, and I got one for Neel. We're going to close, so go ahead.
So total debt is $20 trillion. Ratio to GDP is the highest since World War II in a peaceful environment. People are just talking about the level that they're going to increase the annual deficit as opposed to the aggregate debt. And we have interest rates that are probably 2 to 3% lower than normalized interest rates, which would add 10% to the federal budget someday. You know, how do you feel about all that? You know, and we talk about investments, and yet how can we afford that when you throw another 10% liability out on the government spend?
Yeah, long term, we absolutely have to get our fiscal house in order. And the deficits that you're talking about today, which are important, are minuscule compared to unfunded entitlements of Social Security, Medicare, and Medicaid. By the way, most of these programs are current workers paying for current retirees. So as the demographics problem gets worse, all those programs get worse. And so a lot of these do come back to demographics, and we need to address that. So long term, you're 100% right. We have to address this. In the near term, the whole world, investors all around the world, are looking at major economies and saying, we're the strongest weakling, in a sense. We're the safest place to invest, even with the facts you just said, because Europe has its own issues, which are worse. Japan has far worse demographic challenges. China has its own challenges. And so right now, everyone is flocking to treasuries because they view the treasuries as the safest place to put their money. So right now, global investors are taking the opposite view than you just articulated, because they're saying right now in the near term, no place is safer than America. But there's no question that long term, everything you just said is right, and we have to address this. And that starts with addressing the unfunded entitlement programs, which is really just a political challenge. I mean, we understand how to balance these. These are levers that Each of us could decide to pull different levers between taxes and benefits to balance them. It's just a political calculus of how do you reach consensus to do that. So important long-term issue, but I'm not something I'm worried about immediately.
Go ahead.
Going back to '08, you mentioned you weren't getting a lot of sleep. There was a lot of fear, emotions, panic. Often you don't make the best decisions in those situations. Going back, you wish you could have made other decisions, other plans. In a capitalist society, should we have let some companies go bankrupt? What would have been a more optimal solution?
You know, I've thought about this a lot, and so I give my boss, who was Treasury Secretary Paulson, and then Fed Chairman Bernanke, tremendous credit, because their spirit, their approach was, let's try everything. And hopefully the combination of all that's going to be enough, recognizing some of the things we're going to try aren't going to work. And some of the things we tried didn't work. But together, the combination of everything did work. Picture this. You've got a fire raging in a neighborhood, and you're afraid the whole town is going to burn down. You would like to say, you know what, let's just let a few of these houses burn to teach somebody a lesson. But then the fire really might get out of control. And so in that situation, you say, you know what, we're going to bring in all the firefighters we can, shoot all the water we can at this to just try to put the fire out and get control of it. That was the right thing to do. And the better thing now is let's make sure this can't happen again. Let's make sure we're either building our homes so that they're much more fire resistant, we're building them farther apart. You know, let's learn from this. Because the thing is, human societies repeat the same mistakes. Now, it's not usually the same people. It's not you and I. It's our kids or our grandchildren who end up repeating the same mistakes. So the question is now, while we all remember how bad the crisis was, can we institutionalize some of the reforms to make it much less likely that a future generation repeats the mistakes that led us to this terrible crisis that we experienced in 2008?
Sure.
Going to things we don't know in a modernizing economy, my understanding is a lot of the tools that are used now are decades, if not older. What are some of the things that we're doing to modernize how we measure these important metrics to make better decisions?
Well, I think a lot of work is going on continuously to always try to improve our economic statistics, whether it's unemployment measures, inflation measures, GDP measures. You know, some people are saying, well, maybe the economy is growing faster than we think. We're just mismeasuring GDP. I don't really, I think there may be some mismeasurement, but I don't really buy that that's the source of all of our problems. But everyone is always trying to improve these measures. And even around the Federal Reserve, different Federal Reserve banks are regularly coming out with new measurements that they think are better. And then some of those get traction, and we start looking at those, and those gain a lot of focus and attention. Sometimes measurements fall away because they become a little bit obsolete or they get replaced by something better. So I feel like measuring these key statistics is an effort of continuous improvement, and I feel pretty good about that. I mean, I don't want to say that our measurements are perfect today, but I like the fact that everyone's always trying to come up with new, better measurements, and we're open-minded. If somebody comes up with a better measurement, hey, that's fantastic. We can all benefit from that. And so I think that's going to continue, and that's a real good thing.
So we're going to close with this. I'm going to ask Neel about the economy, not politics or the election.
Thank you.
Yeah. What do you see happening in the next 12 to 18 months?
I'm glad you didn't say the next 6 weeks. My best, most likely scenario is continued moderate growth, around 2% real GDP growth is what we think. The U.S. economy is slow but steady right now. We would all like it to be much faster but steady, but our base case scenario is continued slow but steady. And we're always looking out for shocks. You know, Brexit we were worried about. Turns out, at least so far, it has had less of an effect than we had expected, which is a good thing. But this has a lot of room left to run. We don't really know how this is all going to play out. We don't know if Brexit is going to be a clean break, how costly it's going to be for the UK, what it's going to mean for the rest of the Eurozone, and in turn what it's going to mean for the US. We don't fully know what the slowdown in China is going to mean for China, let alone for the US. So there are a lot of unknowns out there. But our base case scenario is continued slow but steady growth. And the big question mark for us in the US is what's happening in the labor market. How much more slack is in the US labor market of workers who can re-enter the labor force before this tight labor market becomes inflationary? And that's probably the most important thing that we're paying attention to right now in terms of what it means for the U.S. economy and for U.S. monetary policy.
Great. Well, again, on behalf of the Minneapolis Bank and the Doherty family and companies, appreciate you giving us some time and opportunity to listen to Neel and hear his views of the economy. So thanks again, and have a good conference.
Thank you very much. Appreciate it.